You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, Bubble.com, written on the 2001. Let's dive into the timeless insights that continue to influence investors today. And if you're enjoying the content, don't forget to like, subscribe, and share your thoughts in the comments. Your support helps us bring more valuable insights to the investing community. Now, let's get started. All right, let's jump right in. Today, we're taking a trip back in time to the year 2000, the peak of the dot-com boom. Remember those days? Everyone was talking about the internet changing the world. Fortunes are being made seemingly overnight. And you know what? They were right. The internet did change everything. But as we'll see, not everyone who jumped on that bandwagon struck gold. Our guide for this journey back in time is an insightful memo from the legendary investor Howard Marks. It's called, appropriately enough, Bubble.com. And even though he wrote it right smack in the middle of that dot-com frenzy, Mark's words offer some timeless lessons about market psychology and, the dangers of getting caught up in the hype.
Yeah. Bubble.com is, it's really a fascinating read even now. It's remarkable how relevant his insights into investor behavior are even decades later. We'll be exploring those insights today to see what lessons we can learn and apply to our own investment decisions.
Okay, so Mark starts off with this incredible story about Sir Isaac Newton and the South Sea Bubble of 1720. You've got to hear this. The guy who figured out gravity got swept up in a speculative frenzy, lost a ton of money, and then famously said, "I can calculate the motions of the heavenly bodies, but not the madness of people." If Newton could get caught in a bubble, what hope do the rest of us have?
Right. It's a powerful reminder that even the most brilliant minds can fall prey to the allure of easy money and the fear of missing out. And that's exactly what Marx is getting at, you see. These speculative manias, they're driven by these timeless human emotions that transcend any particular era or industry.
So true. He even includes some quotes from that era that sound eerily similar to what people were saying during the dot-com boom, like private vices producing public benefits, which is basically greed driving the market. Or that you just need to find a greater fool to buy your overpriced stock. It's like, as Mark Twain would say, history was rhyming.
Exactly. And what's really interesting is how Marx connects these repeating patterns of behavior to those dot-com companies. He recognized the potential of the internet to revolutionize things, but he was skeptical about the sky-high valuations of a lot of those tech companies and whether those valuations were actually tied to any real sustainable profits. He asks a question that every investor should really consider. Will all this innovation actually translate into a profitable business?
Yeah, it's not enough to just have a great idea. You need a solid business model to actually turn that idea into profits. And for a lot of dot-com companies, that was a big question mark.
Exactly. And that's where Marx really digs deep, highlighting some specific challenges those companies faced when it came to making money. Especially in a world where so much of the internet was free, people were assuming that the internet would eliminate the need for things like, advertising or physical inventory. But was that really realistic in the long run?
Well, Marx uses this series of jokes his dad used to tell to really illustrate the flawed logic behind some of those assumptions. Things like, we lose money on every sale, but we'll make it up in volume. It's funny, but it also points out a basic truth, right? Profits can't be ignored no matter how innovative or how disruptive an industry might seem.
You got it. And it's not just about making any profit, it's about generating sustainable profits. He gives the example of Webvan, the online grocery delivery company that went under. They were trying to revolutionize the grocery shopping experience, but they ran into problems like those small order sizes and the really high costs of delivery. It really highlights the gap between all the hype and the reality, and how important it is to really think critically about how practical a business model actually is.
It's a good reminder that even the most promising ideas have to be tested against the realities of the market. So what makes a business model truly sustainable, especially in such a fast-paced environment like the internet?
Well, you have to consider the competition. The internet, with its low barriers to entry and the ability to scale up quickly, it can be an incredibly competitive landscape. Marx points out that even the dot-com companies themselves were going to face fierce competition, which would make it even tougher to achieve that sustainable profitability. Think about it, right? Minimal product differentiation. Everyone's focused on keeping prices super low, new competitors popping up all the time. How do you build a lasting competitive advantage in an environment like that?
Right, it's not enough to just be the first one there. You need to build some kind of protection around your business, some kind of moat to
Yeah.
protect yourself from that wave of competition. And sometimes those moats are harder to build than people initially think. I mean, even Amazon, a dot-com darling
Mhm.
that ultimately did become successful, even they had to change their strategies over time.
Precisely. And that leads us to another critical piece, valuation. Marx was really astonished by the astronomical price to earnings ratios of companies like, Yahoo and AOL. To give you an idea, he points out that for the combined price of AOL and Microsoft back then, you could have bought a whole bunch of well-established companies with much higher sales and earnings. It makes you really wonder what kind of expectations were baked into those tech stock prices.
It's like people were betting that those companies would become 10 or 20 times bigger than they already were, right?
Exactly. And that's where this whole bubble idea really comes in. Marx is essentially saying that even if you truly believe in the long-term potential of these companies, the prices that people were paying for their stocks were simply unsustainable. He compares it to a lottery ticket mentality, where investors are so fixated on the potential for those huge gains that they're completely overlooking those traditional valuation metrics and that high probability of failure and that fear of missing out. It's a powerful force.
Especially when you see everyone around you getting rich. Okay, so we've talked about the difficulties of achieving profitability and the importance of thinking about competition and valuation. But are there ever times when these ideas don't apply?
That's a great question. Of course, there are always exceptions. Exactly. There's no one-size-fits-all approach when it comes to investing. You have to be able to assess each situation on its own and make informed decisions based on your research and your own risk tolerance. And it's crucial to understand the philosophical foundations here, too.
What do you mean by that? What are the deeper philosophical foundations at play?
Well, Marx is highlighting this tension between two opposing forces. You've got the power of human ingenuity and innovation, right, represented by these incredible new technologies. And then you've got the limitations of human psychology, which can lead us to make irrational decisions, like paying too much for assets or getting caught up in these speculative frenzies. Understanding this tension is key to making smart investment decisions.
So how can investors navigate that tension and avoid falling into that trap of those speculative bubbles?
That's exactly what we'll explore as we dig deeper into Marx's memo. He offers so many insights into market psychology and investor behavior that are just as relevant today as they were back then.
I can't wait to unpack those insights and see what practical takeaways we can glean from them.
Me too.
It's going to be a great discussion.
Definitely.
Let's take a quick break and we'll be right back with more from Howard Marks and Bubble.com.
Sounds good. So, picking up where we left off, Marx goes on to talk about the venture capital world. They were pouring money into dot-com startups, like at an unprecedented rate. He does recognize the incredible returns that some of those VC funds were generating, but he also raises some red flags about how sustainable those returns actually were.
So he's not saying that venture capital is a bad investment, but he's definitely urging some caution and a little dose of realism.
Exactly. He points out that even during the dot-com boom, the median returns for venture capital funds, they were much less impressive than those headline-grabbing outliers you always heard about. And you got to remember, venture capital is inherently risky. You're betting on these early-stage companies with business models that haven't really been proven yet.
Yeah, it's kind of like trying to pick the winning lottery ticket before the numbers are even drawn.
Right. Exactly. And Marx also brings up the challenge of timing the market. Those best opportunities, they often come up when sentiment is low and capital is scarce, not when everyone's chasing the same hot trend.
So it's about having the discipline to kind of zig when everyone else is zagging.
You got it. And that contrarian mindset, it applies to other areas of the market too, like especially IPOs. Back in the dot-com era, IPOs were almost guaranteed to make money. Getting in on a hot IPO was like winning a golden ticket.
Wow, it seems like a completely different world from the IPO market we see today.
It was a wild time. But Marx raises some really important questions about the due diligence that was being done on those IPOs. And if those post-IPO stock prices could really hold up, you had companies going public with these crazy valuations, often with little to no history of actual profitability.
It's almost like buying a house based only on those fancy brochures. without even bothering to get an inspection.
Yeah. That's a great analogy. And Marx even observed that it seemed like some companies were being formed with the IPO as the ultimate goal, not actually building a real company. It was all about cashing in, not creating a lasting business.
So was it really about innovation then? Or was it just about making a quick buck? That's a good question to think about, isn't it?
Absolutely. It speaks to those deeper motivations driving the whole dot-com bubble. Was it purely about creating these world-changing companies? Or was it fueled, at least partially, by greed and that allure of Wall Street speculation?
That's a real interesting point, and it makes me wonder, are there ever situations where aiming for an IPO as like the primary goal is actually a good strategy?
Well, an IPO can be a great way for a company to raise capital and get more visibility, but it shouldn't be the only thing they're focused on. A company should be focused on building a strong foundation, developing innovative products and services, creating real value for their customers. The IPO should be like a result of success, not the goal in itself.
So it's about having the right priorities, building a solid business first, and then letting the IPO happen naturally from that success.
Exactly. And that aligns with this idea that true value creation should be at the heart of any business venture. It's not just about playing the market. It's about contributing something meaningful to the world.
That's a powerful perspective. Okay, so we've talked about venture capital and IPOs, but it's important to remember that Marx isn't saying that all tech companies were destined to fail. He recognized that technology has the power to change the world, and that some companies would come out on top.
Right. He's arguing for a balanced and thoughtful approach to investing. It's not about avoiding tech altogether. It's about understanding the risks, doing your homework, and not getting caught up in the frenzy.
So how do you determine what these companies are actually worth then? Especially when those traditional valuation metrics like price-to-earnings ratios don't seem to apply.
That's a tough question. And investors are still wrestling with it today, especially when you're dealing with these disruptive companies that might not be making money yet, but have huge potential for growth. Marx doesn't give a simple answer, but he suggests that you got to look beyond all the hype and focus on those fundamental things, like a company's competitive advantages, their ability to generate cash flow, the quality of their management team, and how big and sustainable their target market is.
So you're basically looking for companies that are built to last, not just riding the wave of a trend.
Exactly. And remember, just because something seems overpriced doesn't mean it's going to crash right away. Prices can stay irrational for a long time. Sometimes things can even get more overpriced.
So you're saying that even if you spot a bubble, trying to time the market is risky.
It is. Marx warns that even professional investors, they can get caught on the wrong side of a bubble. The market can be unpredictable, and sentiment can drive prices way beyond what makes sense.
Okay, so let's bring it back to Marx's core message. What are the key takeaways for investors who want to avoid getting burned in the next bubble?
Well, he reminds us that eventually valuation has to matter, no matter how revolutionary the technology is or how compelling the story is. At some point, the price you pay for an asset, that's what's going to determine your return. And if that price is too high, even the best company in the world can be a bad investment.
So even in those really exciting and innovative industries, valuation always matters.
Got it. And building on that, Marx emphasizes how important value investing is. Buying assets for less than they're worth. That principle holds true no matter what the industry is or what the market's doing. It's about finding those undervalued opportunities, even if they're not popular at the moment.
So don't be afraid to go against the grain and think for yourself.
Exactly. And remember what Barton Biggs said? He was a respected market observer at the time. He said the dot-com craze was one of the greatest, if not the greatest, manias of all time. He predicted it would end badly. And sadly, he was right.
It's a sobering reminder that no bubble lasts forever.
Yeah.
So what are some of those psychological traps then that can lead investors to make bad decisions during these times of, market mania?
Marx goes into some of the psychological factors that drive these speculative bubbles, like the fear of missing out, the pressure to conform, the tendency to believe all the hype. These are all deeply human emotions, and they can cloud our judgment and lead us to make impulsive decisions.
Okay, so it's not just about understanding the numbers. It's about understanding ourselves, our own biases, and how those biases can influence how we behave.
Exactly. And this leads us to one of the most important questions that Marx asks. What is it that drives these speculative manias? Is it just greed? Or are there other things at play too?
That's a really interesting question. And it has implications that go way beyond the financial markets, I think.
Absolutely. It gets into our understanding of human nature, why we're susceptible to irrationality, and those collective delusions that can grip a whole society.
It's almost like we're programmed to chase those shiny objects, those promises of easy riches, even when logic and history tell us to be careful.
It's a powerful force, and Marx's memo gives us a way to understand these forces so we can make more rational decisions.
So it's not just investment advice, really. It's helping us understand ourselves better.
I think so.
Yeah, it really does seem like humans are always struggling with that tension between our incredible ability to innovate and our tendency to be irrational.
It's fascinating, isn't it? And Marx's memo really gets to the core of that. He helps us see how those psychological factors can really drive market behavior and sometimes lead to those speculative bubbles that eventually burst.
So as we wrap up our deep dive into bubble.com, what are some key insights investors can take away from this? Things that can help them avoid those pitfalls in the future.
One of the biggest takeaways for me is Marx's emphasis on recognizing our own biases. We all have them, whether it's that fear of missing out, or the tendency to follow the crowd, or even just that belief that this time it's going to be different.
So being aware of those psychological traps, that can lead us to make those irrational decisions.
Exactly. And once you recognize those biases, you can start to develop strategies to deal with them. Marx encourages investors to really think independently, do your own research, and be skeptical of any advice that sounds too good to be true.
So don't just blindly follow the hype. Do your homework and really think critically about the information that you're getting.
Exactly. Another key takeaway is to focus on the long term. Markets move in cycles, and there will always be periods of growth and decline. It's easy to get caught up in those short-term swings, but the best investors are the ones who can maintain that long-term perspective and ride out those inevitable downturns.
So having the patience and discipline to stick with your investment plan, even when the market is making you nervous.
Exactly. And remember, diversification is crucial. Spread your investments across different asset classes and industries. It helps reduce your exposure to any one particular risk.
Don't put all your eggs in one basket, bro.
You're right. That's the idea. And finally, I think it's a good idea to find a trusted advisor, someone who understands your investment philosophy and can help you navigate all the complexities of the market.
Yeah, it's always helpful to have someone to bounce ideas off of, someone who can give you objective advice and help you stay focused.
Exactly. And, I think that's one of the things that makes Mark's bubble.com memo so valuable. It's not just about avoiding the mistakes of the past. It's about developing a sound investment philosophy that can guide you through all the ups and downs of the market.
So it's a reminder that even though markets can be irrational in the short term, over the long term, value and fundamentals will win out.
That's it. And I think Marx would agree that while the dot-com bubble was a unique event, the lessons we can learn from it are timeless. They apply to everyone.
Well, that wraps up our deep dive into Howard Marks' bubble.com memo, a great reminder that even in the most exciting and transformative times, it's important to stay cool-headed and remember those fundamental principles of good investing. It can help you avoid getting swept away by the tide. Thanks for joining us for another deep dive.
It was a pleasure being here.
Until next time, happy investing.